Welcome to the Broken Pie Chart Podcast, episode 286. I'm your host, Eric Moore. Back with me once again is my semi-permanent co-host, Jay Pestrichelli. Jay, what's going on today?
Derek, it's a nice rebound week, don't you think? Kind of a little rebound back this week. Some big numbers. Market seemed to like it. All of a sudden, wait, what? Was it really a bad jobs number? What? Are people really worried? It's almost like it was all undone. What happened? If you went to sleep for 2 weeks and woke up, you go, what did I miss? What did I miss?
I mean, don't you think that, okay, so we've had a very nice recovery off the bottom of the lows on the 5th of August. I mean, I think certain stocks, I believe NVIDIA is up like 30% plus from its bottom. But I mean, do you get the sense that I didn't hear a lot of people calling for this? I didn't hear a lot of people saying, oh yeah, this is totally going to reverse. It's going to be up strong. It's going to get, we're going to be marching towards all-time highs. We're not quite there yet. We're still got some distance. But don't you think like no one was really touting this? I feel like it was really doom and gloom on the TV networks.
Well, that sells better. We know that. It
does.
The other thing that I would say here is, I've got this rule of three, and we've talked about this many times, right? Usually it takes three things to panic people. And what now I got to remember what the three things were, right? So you had the carry trade that unwound.
Yes.
You had Warren Buffett sold half his Apple position. What is he getting? What is he getting all set for? And then you had the weak jobs number on Friday. So, but not even that weak, just not as strong as expected, in my opinion, right? And those three things and all of a sudden that became the narrative. So you're right, not a lot of people were talking about, that's nonsense, but everybody was then, I feel like, on pins and needles waiting to see the retail numbers, and they came out strong this week, and that was it. The market's been up, gapping up on the S&P, which means opens up notably higher than where it closed the previous day a couple times in a row this week. Those are, we could have a whole probably show about gap theory, right? But those were pretty strong days. At this point, after passing here, it feels like there's a pretty strong momentum to ignore that information. The CPI data wasn't prohibitive enough to make the Fed not raise, which again, that is a perverse scenario. I'm sure we're going to talk about it. We always do. So it's just, some good news erased that bad news. So I guess two or three things erased the two or three things from the week before.
You mentioned the Buffett selling Apple, and whenever those numbers come out or those, the holdings come out, it's already happened. But I saw something a couple people mention, and I was thinking it myself, Berkshire's holdings in Apple, I think them selling means the indexes have to buy more. And the reason is because aren't those, what do they call it, Jay? Like tightly controlled shares, when they look at the float, like the tradable float versus the non-tradable. This is from Fortune. In the wake of, and I'm quoting this, in the wake of Berkshire sale, passive funds tracking these indices, or indexes they call it, may have to buy as much as $40 billion of Apple stock when they next rebalance, according to Piper Sandler's estimates. That's triple the average daily volume of the company's shares over the past month. So that's interesting.
That is, I guess, okay, it makes sense because the keeping the weightings the right way. That report, though, was as of Q2, right? The end of Q2?
Yes.
Yeah. And so, by the way, I'm looking, the highest Apple hit in Q2 was 216. Of course, today it's at 226. Apple did have that big gap shoot up in after, the AI announcement in June. So if Berkshire was selling, this is June 11th. So if Berkshire sold any time before the last 20 days of the quarter, they couldn't have timed it worse.
Yeah.
Right? And look, I'll never criticize the longer term view and positioning of Berkshire, but I got to say there are plenty of times where he's really early on these kinds of big swings.
I mean, maybe he has an idea of what he wants to do with the money. I mean, that's possible too. It's not necessarily that he's getting out of the market and staying in cash. We won't know until
we won't know again. We won't know again. You're right. Look, and they didn't sell it all, right? They didn't sell everything. They just took some off.
I don't think so.
Although someone's kicking themselves if they were out before that AI announcement. It's like, really? This thing hasn't moved for like a year and a half, and then it goes up 20% in 2 days or whatever that number was, and like 10%. It's like, oh my gosh. By the way, that has happened to us how many times?
Mm-hmm.
Numerous times, right?
Sure.
Yeah.
Sure.
I don't even want to name the one that just happened to us. So let's just move on from that.
Yeah. But anyway, yeah. So apparently, they look at float adjusted market cap. And so if you have what's considered, shares that are not going to be traded or controlled or anyway, I'll leave
Treasury shares, they call those, I believe. I think that's what you were going for. Yep.
We'll let other people go to the details, but that would be interesting. Like, oh no, everyone's like I'm going to sell now because Warren Buffett sold, and then this comes out that oh no, the indexes now have to buy 40 billion of it. Or did he sell 50 billion?
So, yes, big number.
So basically, they're apparently anyway. All right, let's go to the VIX. You and I talked about the VIX, but we had. I think it's worth revisiting this. There's a chart from who is this from? This is LSEG, Reuters. Yep. So, history of VIX spikes, Jay. When the VIX has risen close above 35, so it closes above 35, as it did on August 5th, the index has taken 170 trading days or sessions on average before returning to 17.6, its long-term median. You've seen the chart, otherwise I would make you guess. But 7 days, I believe, 7 trading sessions from August 5th. So went above 35, came back down below 17.6. Put this into context in 2022, March 7th, took 285 days. February 27th, 2020, took 276 days. What is this? December of 18, only 21. Feb of 18, that was the apocalypse, 13 days. And then 2015, 8/24/2015, 32 days. So, yeah, this was fast. Like it shot up and then it shot back down.
Yeah, and so the numbers here are when it's essentially for averaging out, when it got to be double its long-term average, right? How long did it take to get back down, right? 35 is twice 17 and a half. So to get back down, to be cut in half after getting to be 2x past its average, only 7 days. So it's a very quick decline to get back below that number. Today, where do we close today? 14.8. So it's
all good. Yeah.
It's falling faster, right?
Music's back on. People are dancing. No problem.
I don't know. There's a lot of people that, are still shaking their head from what happened, not last week, right? So, or at this point, 2 weeks ago. So, yeah, I don't, so what does that mean, right? You could equate this as to, should it have even got to 35? I mean, it is what it is. It traded where it traded. There's real money and real math that caused it to happen there. But I think there's a lot of folks that thought that move was just we've said it, right? It was just really unwarranted. So, and it's tough to know by the way, in the middle of it all, because when you see, the negative flashing and flashing more and more and more, you're going, wow, there's something wrong that I don't know. And it's first off, I don't even know what this carry trade thing is, and I have no idea how it's going to affect everything. How could it be pushing us down so much? It was a little, we've said it more than once.
I mean, the third highest spike ever. Remember, the VIX was not in existence in 1987. That would have been the highest by all studies, kind of doing some back testing on that. But yeah, I agree. It's sort of mismatched. 2008, though, you remember that? Like 2008, it took forever for the VIX to come down. I feel like it was above 40 for a long time. It was above 25 for a long time. Like it took a while. That was really elevated, that whole period. Okay, so the other thing, you talked about this, and I'm glad you brought it up. the VIX Index is not a tradable product, and its calculation is just a formula, and it looks down across the chain of about the 30-day out S&P 500 index options. So you could have a bid ask, and I believe they have to have a bid to be included in this, and they weight the different ones down there. But you could have a bid ask, and the thing shoots up and it never trades. Jay, when I pulled the high of the VIX Index, which spiked above 60, but then I also pulled the CBOE, the front month future, and that only got to 37. That's pretty big gap. Now the future actually trades.
There's that. Yeah, that's a tradable vehicle, right? Of course, it's based off the price of the index at a certain date, but that's a vehicle you can actually, buy and sell the futures. Yes.
What was interesting about that is I said, well, that's a pretty big gap. That's pretty significant. And I look back and I said, well, let's go to February of 2020. And remember that was the, we won't mention the C word. We don't want to get the Joe Rogan treatment, but it was, the sickness was happening. So that's all right, whatever.
Wow, you're really dancing on that one. Yeah,
I'm dancing. I don't want the blue label. They did that to us. We didn't. So we just said the word, and we talked about the recession.
Pandemic, no,
I don't know. But
I said it.
We got labeled. We got labeled back then. All right, so
labeled.
Yep, probably so. So the VIX spiked. Let's see, above 80 in February, actually in mid-March, and the futures almost spiked as much. It was above 80 for both. So that's a case where, it seemed like it was warranted. Everyone was on the same page. This is bad.
Okay, look, I'm trying to think through this when you're digesting these things. And a little bit of this is the challenge, right? You watch the market dictates your bias, and you have this recency bias, right? And so to me, and you've said this all the time, right? The emotional reaction of what's happening can kind of compound on itself, and my opinion is now of what happened recently must be the real truth. And that fear that you get there is like, it's you got to take that out, right? And so you've talked about this in the past, right? You've definitely talked about the recency bias and how it definitely compounds here, and all of a sudden it's a self-fulfilling prophecy.
Yeah, I think what's interesting about these, and we looked at some other moves to the 2015 one, also had a really, really significant gap that went up to, let me see, right scale. Yeah, it went to about 53 on the VIX, and the future probably only went to about 25. So pretty big gap. The 2015 is similar, at least in our eyes, because it was both currency driven. But you pointed something out too in the chart, and we don't know what's going to happen going forward. And by the way, that's why we buy and we hedge. That's one of the core things that we do. We buffer. But it seems like when there's this gap, historically, and I shouldn't say historically, we're just looking at a couple examples, you do get a subsequent spike where the VIX isn't as high maybe, but the futures spike above its previous spike.
Yeah, all of a sudden the trading catches up because they're like, okay, maybe this is real. I don't know the mentality of a VIX futures trader. I know my mentality when I see these things happen. You get that first spike and there's the gap where the futures are really lazy. But on the second spike, the futures are right along there with it. So now, in all of these examples, at no time did the VIX get back down below that 17.5 down to its average.
Right.
So it stayed elevated, right? But then it just needed a little push to bring the futures along with it. I don't think we're in that situation right now. So in other words, if the VIX, next week pops to 30 again, I think we've reset the futures mentality, and they're probably sluggish again after. Who knows? But to me, I feel like this, decline, once this decline happens, it's back down to parity. They're back down to running together. And, actually, I'm looking at your chart. Do you see the futures a little higher still than the VIX currently? Interesting.
Yep.
So it's even a little lazier coming down. But I don't think the pop-up would see, a follow-through of also a similar size spike, which again means the VIX is a hard vehicle to use to hedge after you have a move like this. There's probably a better way to do it.
Looking at 2008, 2009, the VIX Index went above 40. It went above 40 in late September. It stayed above 40, based upon what I'm seeing here, until the end of March of 2009. Like, think about that. That's a long time to be above 40.
Yeah, I remember.
Well, me too. I mean, yeah, I'm familiar with that time period for sure. But all right, so I think there's a couple things, and I like to talk about the narrative that we're hearing. And the sentiment right now is that the Fed is going to lower rates. It's getting, I think it's priced in 50 basis points. We got some CPI data, and I would say no one got what they want, which meant it was a pretty good CPI report. And what I mean by no one got what they want, it's like, okay, the bears said, no, it's going to be more than 0.2% month over month. And the bulls said, oh, what if it comes in at zero? It's going to, it came in exactly as predicted, 0.2%. No one got what they want. And, you look at the CPI year over year, it's down to 2.895% year over year. That's not cumulative. And Supercore drifted down again, but Supercore is still 4.468. So I don't know. I mean, I look at the stuff that's in the CPI, which includes the everything. It's services. Services are 2.92% year over year up. Goods down 0.4%. Like, this is all services. This is like hospital services. It's what do we say? Recreation. Yeah, like, it's services. So
your financial advisors' fees.
They're not going up.
They're definitely not.
No.
We're helping this. Yeah, I mean, like, what? That's the big chunk now. So what? What is it? Commodities that could impact that? Is it right? Like, is it travel?
Well, it's housing. No, but shelter's a service too. It's considered a service.
So what? So when they cut rates, our housing price is going to drop.
I mean, all right. So housing, and we hear this all the time. There's a lag. Nobody was telling us about a lag when housing was low and they were actually going up. But no, I would argue that. So what happens? So supply probably comes online because someone who can't move with a 3% mortgage, and I don't know. I mean, mortgages may not go down materially enough that enough people can move. But I would say supply can come off. I think people could afford more homes. I don't know. I think actually marginal buyers can come in if they lower rates.
Yeah, I've been trying to think through that dynamic with the current situation. So I'm going to just do a little stream of consciousness here. So the idea is if you've been waiting to buy somewhere, but you're like, I can't afford the 7% mortgage. I think they're down to 6.5%, right? And you're waiting, and mortgage rates drop, right? And you go, ooh, okay. Now you can afford more home with your dollars, right? So sellers that have been kind of holding out, right, that have been holding their price, they'll get their price, right? So I feel like there's like this scenario where it actually, home prices will go up when the rates drop because more transactions are going to happen, right? And now on the flip side, if you have to sell your home, you're a seller, I think and you have to move somewhere that's kind of flipping, vice versa. But I'm not sure, Derek. I think there's a strange dynamic here where it pushes housing prices up again.
It could bring more buyers into the fold. I'll get to the sort of Fed balance sheet, but the other problem right now is, so what's the 10-year Treasury? So 6.93% is the bank rate, 30-year mortgage. The 10-year Treasury is what? It's generic. Let me see. Government notes.
2.8. I'm guessing. I'll look it up.
3.8. I know it should be easy for me to find the chart there. I pulled up a chart of like the price of it. I can't do the math that quick. It's like 3.839. Yeah, call 3.9. Okay, so here's a little thing. When you look at the 30-year mortgage rate, and you take 6.93, and we'll do this live, Jay, minus 3.89. That's 300 basis points difference. Historically, it's more like 170 basis points. So the reason I bring this up is that the Fed is still letting MBS bonds come off their balance sheet, that's tightening. So there's also this theory that between lowering rates and if the Fed were to be a little less aggressive as far as, letting that stuff run off and the MBS market normalizes, you just getting a compression alone. I mean, if 3.9 plus 1.7 brings you to 5.6. I mean, to me, rates should be more like 5.6 right now on the 30-year, not 6.9.
Yeah,
but I don't disagree with you. Like, in a weird way, like, I guess we can't have it both ways, because you and I both said that when they raise the rates, it would increase rental cost. Because, if you have a loan on the property, they got to charge more. The way they do the CPI for shelter, though, remember they call homeowners and say, if you're going to rent out your house, what would you rent it for? So, I don't know. Yeah, we didn't plan on talking about this, but, that's
I know
how we kind of talk through things. But shelter is still, it's still above 3% year over year. When you look at that, when you look at core, Supercore, transportation services are up 2% year over year, but that's insurance rates.
Is that it? It's not. Yeah,
it's car insurance.
Yeah,
I mean, car insurance is all going up. So, yeah, I don't know. All right, let's talk a little about the Fed balance sheet. I sort of teased it. The Fed balance sheet at one point was close to $9 trillion. It's only Jay, 7.17 trillion.
Only, got it.
And it's been coming down. And in June, the Fed adjusted its policy. They slowed the reduction in its treasury holdings from $60 billion per month to $25 billion per month that they would let run off. And they continue to trim its holdings of MBS mortgage-backed securities by $35 billion. So for anyone who's like, what is he talking about? The Fed has a balance sheet. As things mature, they can say, oh, $25 billion in treasuries matured, so they could go and replace those that just matured by buying other ones. And it would be, they buy $25 billion. So they are letting it get reduced by $25 billion in treasuries, $35 billion. I don't know. I mean, no one really talks about this. Like, why wouldn't they just stop doing this? Stop letting it run off first before. Wouldn't this be the first thing they would do before lowering rates?
How impactful is this really, right? Like let's take a look at this, right? So as they've been letting it kind of come off, have rates been dropping steadily? No, they didn't really go down too much until recently. So I'm not sure how
it's restrictive. It's supposed to have rates go up because they're taken out of the market as a buyer.
Oh yeah, so right. So there's no bottom. So okay, right. So has that been happening as they're pulling this off?
I think so. I think, we've seen some of the long end go up. I mean, recently it's come back down, but no one really talks about this. And I just kind of wonder, before they lower rates, like, why wouldn't they just say, oh, our balance sheet runoff, we're just going to stop doing that? I don't know.
Look, they're cutting in September, dude. That's happening regardless of what this balance sheet thing looks like.
Oh, yeah, I agree.
But could they do... would they just try to get this over with first? I mean, look, I think they feel like stability is one of their core, providing stability here. So doing anything quickly to get that down to the levels of 2014, 16, 18 would take a lot of work and probably cause some instability. And I think they're probably going to avoid that. So, well, you may be, academically correct in practice. I think what would happen if they dumped $4 trillion, right?
Yeah.
It's not happening.
Well, by the way, I mean, at their current run rate, to get back to the pre-2020 levels, it would take a while. I mean, to get back to, 4.5 trillion, that would be some time. But yeah, I mean, here's the other thing. I think, so the 2-year treasury is down to 3.86%. The yield curve is way inverted right now. Anything beyond, 5 years and beyond is 3.5% or lower right now. But I mean, don't you think, Jay, that the 2-year is basically telling us, or the 2-year is throwing its hat in the ring and making a prediction? Yeah, rates are going to be 3.86% in 2 years. It's kind of what it's saying.
It is what it's saying. 2 years. It's so hard, right, to figure that out.
Well, sure.
I'm glad I'm not a bond trader for a living. Mm-hmm. Options sometimes are much easier than bonds. For me, at least there's a mathematical reason. There's a lot of projection going on in this. So is that the right number? Look, I don't think the market would be disappointed with a 3.86 number for interest rates in 2 years from now if the Fed funds rate was 3.8. So let's back into all what we just talked about, right? How many bips did you add on for a mortgage? So you're at 5 for mortgages? Is that about what you're talking about? I mean, Fed funds being 10-year, I know there's a difference, but
yeah. Well, I mean, if in 2 years it's 3.86% on the 2-year, you figure Fed funds should be 375 to 325 or 3. You should get paid more going out 2 years than going out 2 days.
And then what? The 10-year goes a little higher to 4.25, 4.5.
Sure. It can get steeper than that, but sure, I'll go with that.
So now you're if this was your play, right? You want to that you don't trade the longer end of the curve at that point, which is strange. You don't buy the longer end of the curve, which is strange to think as rates go down, actually the longer end of the curve goes up. It's really the normalization is the question. Do we uninvert? Yeah.
Well, I mean, we look at and this is from Bloomberg, the probability of rate cuts for the September meeting is 1.29, meaning 125 basis point cut. The implied rate, 5.002, coming down from the effective Fed funds of 5.33, what money is actually changing hands at. And the November meeting is sort of pricing in 2.5 cuts, 2.5 meaning, and you go to the end of December, it's just under 4 cuts. So the whole thing of 50 basis point cut is, I think there's only a 29% probability now of 225. But I mean, Jay, don't you think like next week, Wednesday, we have the Fed minutes on the 21st. And I think, is Powell scheduled for his talk, his presser, whatever he's going to do? Is that next Friday from Jackson Hole?
Jackson Hole.
Mountains in the background and everything.
I'll always remember at Jackson Hole when he yelled at everybody.
Yeah.
2 Augusts ago. It's like,
yes.
You aren't listening to me. I'm going to raise rates, everybody.
Yeah.
Yeah.
Yeah. Well, that's where the press corps will ask him 20 different ways the same question, and finally did he grab the podium, or I don't remember.
It was like the shortest. It was like an 8-minute thing.
That's right.
And
I think I read somewhere. I'll have to try and find it. He's scheduled for a half hour.
Okay.
So maybe we get half hour. I mean, to me, they use the Jackson Hole, which is next week. And it wraps up, I think, the 23rd for the September 18th. Like, they've been really good at targeting or telegraphing what they're going to do. And right now it seems like 1 cut. I don't think he's going to be bullied into making more than 1 cut, though.
Well, is the market going to like that?
The market just has to know that that's what's going to happen. It can't be surprised.
That's it. The market just has to know. And I think the market is leaning towards the 1 cut. I hope he doesn't get bullied into 2. I don't think. I'm with you. I mean, I've always been the 1 in September, and so. By the way, there's no bet that I have on that one, right? I know at one point we talked about that trading how January won't get 5 cuts, but you're right. Don't get bullied into this. Somebody said, what does 1 do? Like, if you're going to cut, then cut at least 2. my answer is no. It shows that there's a trend changing. You don't have to do all your work in 1 month. You don't have to accelerate it. I think Jeremy Siegel, who I have a lot of respect for, by the way, from Wharton, was out there saying the Fed needs to cut now, emergency, and then another 100 bips, at the meeting 2 weeks ago.
Did he want 100 bips that day? Wasn't that what he was saying?
It was like 75 that day or something like that, right? And so I think he's backed that off a little bit. So it's when you see a pro like that lose their
composure.
That's a good way to put it.
Yeah.
It's always like, ooh. But it's not like that doesn't scare people too, by the way.
Yeah.
He's usually a permabull, but anyway, this is what I would say. Take your time. Like, there's no reason to rush it. What's the rush? Nothing is pressuring. But again, it's not my call. And he doesn't want to. I think he's really good at telegraphing what he's going to do, and I don't think he wants to disrupt the markets too much. He got good data that would support. Okay, I'm not going to cause too much harm by cutting once. Twice almost seems like, what am I trying to get in front of? Where's the data that shows that we have a problem? What? One jobs report that was a little light? Who cares? That could be revised next month, up 100,000 jobs, and all of a sudden everyone's like, oh, I guess that was nothing, right? It's also plus or minus 100,000. So it wasn't like we got a minus 500,000 job report, which you probably remember those from 08, 09.
Yeah.
I remember those, -6, minus 700,000. Of course, during the pandemic, we saw minus millions in a month, but it's not like that was happening. So again, I don't think he's going to get bullied into it. I think he's deliberate.
50 basis point almost seems like it would be a panic. Like they're worried about something. And I think that would do more harm than good to the market. If they come out and they thread the needle and they do a quarter point and maybe they announce something on the balance sheet, I think that could be meaningful for those of us who understand it. And I go back to the unemployment thing. If I told you or everyone that nobody lost their job and 75,000 more people were employed, would you think it was bad? And the answer is probably no.
Right.
The unemployment rate went up because the supply of the size of the labor force went up. No one lost a job. I shouldn't say no one, but I mean on net, more people were working. Like, I'm sorry, that's how the numbers work.
Yep. So what we're saying here is maybe that's all was the blip. You got a 9 we talked about this time, right, last week, a 9% decline, reset, and there you go. Maybe it's all over. We'll see.
Well, companies, number of S&P 500 companies citing recession on earnings calls over the last 5 years. This is a chart from FactSet. 28 during Q2 of 24. To put this in perspective, Q2 of 22, 234 companies, and it's been coming down. So you could be like, the contrarian says now is when it comes, when they're not talking about it. I don't know. I mean, companies don't seem to be too worried about a recession right now, Jay.
Right. That's true. And look, can I go back to even if there is a recession, it's the stock market that matters for us, right? When we come to this podcast and investing. So the market is usually ahead of the recession, right? 6 months ahead of it, with the exception of 2020. It happened so darn fast. Nobody saw that coming. But by the way, it did react to just about the size of the recession. You remember minus 35 versus minus 37% decline in GDP. So the market's going to be ahead of it. Generally, it is. It's not going to be caught off guard on it. We're 4 or 5% off the all-time high. We just maybe we're less than that. Rebounded back. Actually, we're less than that. Sorry, rebounded back off the 9%. Like, it's so again. So what, right? Like, if it's going to happen, the market will be ahead of it anyway. So maybe this comes out that everybody was companies weren't talking about it, and they might have been late. Watch for the market to tell you first anyway. And it's not signaling anything.
No, that's right. The market usually signals it. I will also say that if you go back and you look at a long-term chart and like imagine if CNBC had their archived episodes on where you could go look at a random day when the market was down 2% and everyone's freaking out. And then you look back at what happened later. Like these days are insignificant in the long term. They really aren't. But, I mean, I think I remember we saw a graph, the ratings and the market have an inverse relationship for CNBC, meaning when the market's bad,
of course,
the ratings are up. Like they want doom and gloom. They want blood on the streets. That's what they want,
Yeah,
So,
how many people were watching, the market on that Monday, Tuesday, the 5th and 6th of August, right? A lot more than we're watching it today.
It didn't fire on Monday, though?
No.
The cupcake indicator.
The cupcake, they didn't put the Dow Jones in the bottom corner on local TV.
Yep. Jay, you kind of described it there. It's when your local TV station, and I call it the cupcake indicator because I don't remember what down day it was. They were baking cupcakes in the bottom right-hand corner. They had the Dow Jones. Like they never do that. So I call that the cupcake indicator. When you see that, that's when you buy. Maybe. I don't know. Maybe it works. Maybe it doesn't. But what is getting mentioned, though? 41% of companies mentioned AI during their quarterly earnings calls. 41%. That started to go up at the end of 22 into 23. It's not the highest it's been. Doesn't this mean that they're all spending money? Doesn't this mean CapEx is being invested in this? I don't know.
The talk is you can't afford not to invest in AI at this point, right?
Are you a salesman for AI on your off
if you're not investing in it, you'll find yourself run over by it. I used it today for a job description that would have taken me an hour to write, done in 10 minutes, and was done better than I humanly could have created. It was amazing, right? So there's use in almost everybody's business for this stuff. Oh, I'm not really hiring, just saying.
Okay. Yeah. Well, this is for your AI your sales, your weekend job that you're doing.
In all honesty, like it was very. If you're really not using it, you're not being as efficient as you can, and you will find yourself under the boot of your competitors' pricing at some point, right? So infrastructure, that seems to be the story here. That's obviously been NVIDIA's story. We're going to get earnings on August 28th on NVIDIA, right? And see if they can be can they push this market to the next leg up? I'm not sure. It's you've done a really good job, Derek, in the past, kind of looking into their PE ratio, forward earnings, and what they're talking about. There's still a lot of growth kind of mapped in here, regardless of the stories of, one chip's delayed. It doesn't matter. If they are really, if this is really happening, then, we should see it continue. I don't think, you look, when you talk about quarterly earnings calls, those are sales pitches, right? They're explanations by CEOs and CFOs and COOs as to what's happening in their company. And it's a nice buzzword to use. You should throw up the crypto one, right? You did the same kind of study as a portion of firms mentioning crypto or blockchain. That was a podcast that we did a while ago.
Remember the picture with the skeleton, blockchain and crypto as a skeleton at the bottom of the sea?
No, I don't remember that. But I will say, like, that has come off, right? So these are trends where, I don't know if you could read into this too much, but I do think that this is one of those scenarios that companies have to incorporate it in. Like, why would you not use it? It's like not using Excel for doing your math. There was a point in time when you and I were alive where there was no Excel, right? Before the 90s. And right now the whole financial world operates on Excel. Like if you don't use that tool, you're behind, you're slow, and you're manual, yada, 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 right? I'm not saying...
But you're getting to productivity, and that's I think, a great example. Like, imagine doing what we do without having Excel. Imagine just, a hammer and chisel or a pad and paper and a...
Abacus.
And all right, a calculator. I was going to say a calculator.
Right. Productivity. So that's the story of AI. It's productivity. It's accuracy. I'm not saying we use AI to trade. We don't. There are folks that claim they can. For the options world, no, it doesn't even work. Even automated trading doesn't work great for the options world. So, hasn't been an application there to replace us yet. But, productivity is important. There's a lot that goes around, trading that has nothing to do with trading, right? Reporting, clearing, all those kinds of things.
Don't you think, though, that, by the way, you mentioned NVIDIA's price to EPS, the trailing 69.21, next 4 quarters estimates, forward PE 42.2. And they are looking for, let me see, the quarter, this would be the quarter end of July, right?
Yep.
That's the one. Revenue at 28.65 billion and EPS on 0.644 cents a share. So, that's kind of, and that's growing. I mean, those numbers are up. It's like an extra 2 billion in revenue from last. But all right, I mean, don't you think, though, like NVIDIA, this is the linchpin for this? I like to look at these segments, and your segments are, you have earnings season, you have Fed announcements, you have economic data, and really it's these 3-month blocks. This is the sort of linchpin. Like if they kill it, that's one thing. If they disappoint, I mean, that would be bad. But like, to me, this closes out the season. Let me know what NVIDIA is going to do, and I'll tell you what the market's going to do.
Yeah, I mean, that has been the playbook for the last 15 months when they first blew it out in March 23, right? And changed kind of like, oh, what's this dynamic going on here, right? And then that has been happening. And by the way, not every earnings call have they gone up 33%, right? It's not always been that way. But, and I don't, I'm looking at a chart of NVIDIA while we're talking about it. I mean, trading at 124, high of 140. You're right. The dip on last Monday was almost 90, so up 34 points on 90. That was a screaming buy in hindsight. But which, I think people took advantage of that, and I know we were watching. One of the things I would say here is, I don't know, right? But if it was trading at 150, 160, maybe it's baked in. At 124, I don't know, right? Where it finished last time, it was $95, and then it gapped up. It has closed that gap. There's upward movement in this thing if it can continue to do what it's done. I mean, I'll see what the numbers look like and how the market reacts. But.
Yeah. To be clear, none of you and I are not making a prediction on this.
No, not at all.
If you want to buy it, buy it. If you don't want to buy it, don't buy it. I mean, you make your own decision. What I can tell you is, and even for concentrated stock holdings, so if somebody had a really large position in NVIDIA, we hedge it, we generate income around it. If you want to know more about that, not necessarily on NVIDIA, about stuff we're doing, Derek.Moore at ZegaInvestments.com. That's Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to spell correctly. But yeah, I mean, I would just look like AMD reported early and their earnings were pretty good. I mean, I don't know. And you could have a good earnings report and the stock sell off too. I mean, we just don't know. But 42%, 41% of companies are mentioning AI. I don't know. We'll let you know after reports. We'll come back and tell you what happened. How's that?
There you go.
Lastly, Jay, no landing, soft landing, hard landing. This is BofA Global Fund Manager Survey. 13% now say we're going to have a hard landing. Soft landing is 76%. No landing is 8%. Like, what the heck do they mean by no landing, by the way? Like, what's the definition for that? We just don't know. We don't know. We just
it doesn't land. It keeps going, right? That's a very bullish one where we never needed a landing. We never needed to come down. Let the economy keep growing.
I mean, isn't that soft landing though?
No, soft landing, you landed. You came down, but not hard. Okay, we came down, we touched, and we could grow. Nobody got destroyed. We didn't lose any wheels touching the runway.
Yeah.
Yeah. So a soft landing is like you made it, and yes, we had a little retracement. Seems natural because rates went up, but nobody, we didn't cause a recession, right?
All right, no landing's like 94. 94 is a great example of a no landing. They raised the interest rates, and from 95 through March of 2000, the stock market came off. So there you go. That's where you're predicting, right? And that's an exact replica of that.
Somebody might have been talking about 94 here for almost a year and then some. I don't know.
Just saying. I'm just saying. Yeah, we don't know what's going to happen. All right. But I think, yeah, you're right. So no landing would be like 1994.
Yeah. There's not a lot of people predicting that one.
No, not at all. That's a great point, because soft landing implies
you landed, you came down.
Yeah. Maybe people misunderstand that. Maybe people think soft landing is actually
that's the best scenario.
Well, if you were going to go on TV and you don't want to be proven wrong, you could say soft landing, because if it's not too bad, then you're like, well, I said it was going to be softening. Right?
It's the no risk answer, which you can do absolutely nothing with. So just keep investing and own the market long term. Great, thank you.
I hope people, and I know people did, they panicked and they sold on August 5th. And it's hard, though. We know emotionally it's hard. But the idea that I go back to look at a long-term chart and it doesn't really matter what happens day to day. It just doesn't. It doesn't. So, all right, Jay, let's, any recommendations this week?
I will tell you what I have scheduled to watch. I'm scheduled to watch the new Bad Boys this weekend at home. So I've heard good things about that. I could let you know about it. A movie that I wanted to watch just because of its video game history, which was Borderlands. It looks like it has gotten almost like the worst ratings ever. I haven't gotten to see it. At this point, I think it opened up $4 million first week that it opened up. It seems terrible for a large production. So I would say wait on that guy if that's your thing. If you ever played Borderlands 1, 2, 3, or the prequel, and soon coming out number 4, I feel like I just have to see it. But Bad Boys is what's on the docket for this weekend. There's also a new Apple show with Vince Vaughn that looks pretty good. Glad to see he's back out there making stuff. That I'm going to let a few of those queue up as well. So I don't have anything of what I watched, but I'm telling you what I'm going to watch.
Do you watch that show Industry on HBO?
I couldn't. I started. It was not, the first season wasn't produced very well, so I couldn't get back into it. I know what they were going for. It was their version of Billions, but meh.
Okay. I also was going to, I've been watching Dexter. That's disturbing that you sort of
root for. You like it, don't you?
It's good. I think it's good. It's a lot of seasons though, so it's gonna be a little
It's not like you haven't recommended a lot of seasons to me before. Just so you know, you gave me The Wire.
Yeah,
watch all those, and that was good.
Yeah. So A Bad Monkey though is on my list as that's a pre recommendation.
Yeah, that's the Vince Vaughn one, Bad Monkey. Yeah.
Yeah, that's on Apple TV Plus. And the other one on Apple TV Plus I saw, it's another pre-recommendation, is Ben Affleck and not Ben Affleck. What's his
Matt Damon?
Matt Damon and Casey Affleck.
Yes.
The Instigators. So it's a movie. I like when they do movies. You just sit down, you watch it, you're done. None of this 37 seasons, 57 episodes per season type deal.
37 seasons. You're the only person that keeps watching Survivor, right? Is that like the one you watch that one?
It's the only thing on.
And how many seasons is Survivor?
It's got to be they do one in this fall, one in the spring.
Yeah, it's 30 seasons you've watched of that one.
It's the only thing I watch on network TV.
I don't think I'm exaggerating. I'm not exaggerating.
It could be close to 40. I don't know. You remember though when that first came out, that was massive a hit. Everyone was watching that.
I know. I feel like at the time I had a job that didn't allow me to watch TV, so I think I was not watching that one.
Well, you didn't have to watch it at work. You could watch it.
Well, I was DVRing then. Yes, I know.
VHSing it, right?
Yeah, I didn't have the tape ready.
I was trying to explain to somebody, in the late 70s, early 80s, before the VCR was really around, if you missed it, that was it. You maybe got to see it again in the reruns right before the new season. Remember Who Shot JR? That was big in what was that, 81 or something? Imagine you miss that. And you're like, oh, okay. There's no online, no pulling up the clip, no nothing, right?
Nope. It's very, very different time. So that's how old we are. There you go.
All right. Well, we'll come back next week and talk more about what we think we know, and we'll see what we got right, see what we got wrong. Until then, send us emails. We like emails. And we haven't taken listener questions in a bit. I think I have a couple I forgot to bring in. Next week, we'll do it, Jay.
All right. Sounds good.
All right. See you, everyone. Take care.